So let's start off talking about the Federal Reserve, which this week raised interest rates for the first time since 2018 from 0 to 0.25%. Now, this was widely expected. And the one thing about the Fed, it really forecasts, it lets out into the financial markets what it's going to do. The Fed does not like to surprise financial markets, because then you have all kinds of craziness in the market. So everybody knew they were going to raise it 0.25 point. And the question thereafter was, what's the statement going to say? What's the news conference after? What is the chairman of the Federal Reserve saying going forward with interest rates? And the Fed made it clear that they plan on continuing to raise interest rates, maybe 7 times more this year. Every meeting between now and the end of the year, it is expected that they'll raise interest rates, probably 0.25 point. So when they get to the end of the year, we're talking about 1.75%, maybe 2% interest rates, which is nothing. I mean, historically, the average interest rates have been around 5%. But since the 2008 financial crisis, the Fed has kept interest rates at 0 for almost all of 22 years, 24 years, 14 years, I'm sorry. And this has really hurt a lot of conservative investors. It's hurt a lot of senior citizens and retirees who, look to get interest on their money. What a weird thing to think about. Interest on my money? When I first started in the financial planning business, the financial advice business, in 1983. So what is that? It's 27 years ago? No, actually, it's 37 years ago. It's too early in the morning for me to do mental math. But 37 years ago, when I started in the business, and I remember meeting with people. I used to go to people's houses. That's how we used to do presentations and stuff. And people would show me that they have $50,000 in that gold passbook savings account. And back in the day, you're probably too young to remember, Jim, but back in the day, you used to get this little book, this little gold book. And you'd put money in, and they put the book in the machine, and it'd show your deposit, what your balance is. And the interest rate never changed. It was always the same on a gold passbook savings account, was 5.25%. Now, I used to laugh at people that had a lot of money in gold passbook savings accounts because it was the lowest interest on the food chain back in the day. Municipal bonds were yielding 8% tax-free. U.S. Treasury bonds were yielding 8-9%. Corporate bonds were yielding 12%. And I used to tell people, what are you doing with your money at 5.25%? Nowadays, people would give their left arm to have a savings account paying 5.25%. But we know that's not the case. I mean, we see interest rates in banks fraction of 1%. You're lucky if you can get a half of 1%. 10-year Treasury bonds are yielding 2%. Corporate bonds are yielding 4 to 5%. And meanwhile, we have raging inflation, which means that just guarantees anybody with conservative money is losing money or losing purchasing power. And it was announced this week that the producer price index, the index of wholesale prices, rose 10% year over year. Last month, I think it was up 0.9%. It's the largest increase ever recorded in producer prices. Now, why is that so important? It's important because producer prices are the raw materials. These are the things that companies that manufacture final products, the stuff that goes into the consumer price index. These are the raw materials, whether it's food stuff, whether it's elements, whether it's natural resources, whatever it takes to go into the making a product. And it was announced last week that the consumer price index is up 7.9% year over year, and now producer prices are up 10%. What does that mean? It means consumer prices are going to continue to rise because it takes a little bit of a delay for wholesale prices to work into final products. So inflation is real. And the Federal Reserve, makes 0.25%. This is probably the most meaningless hike in interest rates ever. I mean, a quarter of a point. Are you kidding me? A quarter of a point is just a show. It's done for just to illustrate that the Fed cares about inflation. But in essence, they really don't. But the Fed's statement is very similar to a statement that was made in 1978. And the Fed basically said that they're not going to battle inflation, that they're not going to do what it takes. It's just not real. They can't do it. And in this statement, it basically gave the green light for inflation. And the market knows it. And the interesting thing is the market had one of the best weeks it's had in 2 years. We were talking about the market's been going down since the beginning of the year. I mean, after the Fed met, the market went up. Now, why would the market go up when the Fed raises interest rates and says they're going to raise interest rates the rest of the year? Because the market doesn't believe them. The market believes that just a small increase in interest rates is going to cause recessionary economy, is going to cause turmoil in markets, and the Fed will have to reverse. And not only stop raising rates, start quantitative easing all over again. Another thing that was very interesting in the Fed statement, the Fed didn't say that they're going to start tightening. When I say tightening, I mean reducing their balance sheet. What is the Fed's balance sheet? Well, the Fed, when it prints money, and it has been for years now, $120 billion a month they were printing, and they were buying treasury bonds and mortgage bonds. Well, the way those bonds go, they go into an account for the Fed, and that's called their balance sheet. Their balance sheet went from 600 and something billion in 2008 to over 9 trillion now. Because they kept printing the money, they kept buying the bonds, and now they have all these bonds. They've stopped buying them this month. Last week was the official end of quantitative easing. They're not buying any bonds this week. But the market's wondering when they're going to start selling them. Who they're going to sell them to, I don't know. What that will do to interest rates will certainly raise them in the bond market if and when they start doing that. But they mentioned that they're not going to do it till later in the year. Very, very interesting. When you read the Fed statements, everybody tries to parse every word. And how does this statement differ from the last one? And this one was different because they took that out. Everybody thought they were going to start tightening. They were going to start unwinding their balance sheet. They were going to start selling the bonds that they own. Almost right away. And now they're going to say, we'll do it sometime in the future. You know what my bet is, and many people's bets, I know the Fed very well, is that they're going to just start quantitative easing again. As soon as we have a hiccup in the economy, as soon as we see markets starting to break a little bit, the Fed's going to backtrack and it's going to go right back to its old ways. If we see skyrocketing interest rates in the Treasury bond market, they're going to reverse. They have no choice. And at the end of the day, the Fed has two choices, and both of them are bad. The first choice is to raise interest rates enough to make a difference in inflation, which would wreck the financial markets, will wreck the economy, and just would not be politically tenable. They're not going to do it. They'll put us into a depression. Now, if you remember, now we have very, very similar inflation that we had back in the late 70s, 78 to 80. Very, very similar period of time that we're in right now. And the Federal Reserve at the time, led by Paul Volcker, started raising interest rates. Now, when he started raising interest rates, the federal funds rate, now this is the rate that the Fed controls. When you hear the Fed raises interest rates, they're raising what's called the federal funds rate. The federal funds rate is the rate that banks charge each other for overnight loans. Well, why would a bank need an overnight loan? Well, they have to have a certain amount of reserves on their balance sheet every night. So they borrow from each other. One bank has excess reserves. They'll lend it to another bank overnight at a certain interest rate. So they're all happy. They all comply with the Federal Reserve's requirement. So when the Fed raises the Fed funds rate to 0.25%, now that's what they charge each other. And that flows through the system and interest rates and everything else. So they raise it 0.25 point. Means nothing. Will do nothing for inflation. The only thing it'll do is upset markets. Not the 0.25 point, but when they start getting to 1%, 1.25%. The last time they started raising rates in 2018 into 2019, they got as high as 2.5%, and that's when the system started breaking. And if you recall, there was all these repurchase agreements with the banks and the trillions of dollars. Liquidity was drying up, and the 2.5% interest rates was threatening the financial system, and then they reversed back to zero. So we'll see where that breaking point is. My guess is the breaking point is lower than 2.5% because there's so much more debt now than in 2019. All the debt, all the borrowing, all the money creation that happened from the COVID days are out there and be very sensitive to interest rates. So the market rose during the week because the market feels that the Fed won't be able to raise interest rates in any real significant way, and then they will start reversing that again and printing money, which is good for the markets. The reason why the market went to where it was in the middle of COVID, in the middle of people losing their jobs, in the midst of supply chains breaking down, was because of all the money printing. Money has to find a home somewhere. So that's the reason why the market had such a big spike this week. And by the way, we're in a bear market right now. We're in a bear market. And don't let anybody tell you differently. You have some of the biggest rallies in bear markets, especially when a market is so oversold like this one is. I mean, the NASDAQ was down 14% year to date in mid-March. So, I mean, there was an oversold condition. And like I said, people were relieved with the Fed statement, and it looks like they're not going to be too aggressive. Now, you think that would be bad for the market because that means inflation is going to run, but the market took it as a good sign, and we had a pretty significant rally Wednesday, Thursday, and Friday. Now, will it last? I don't think so. I really don't think so, because what we're really looking at is stagflation, which is the worst economic condition you could have. Because inflation is going to continue to run. They're not going to raise interest rates enough to do anything with inflation. As I said just before, Volcker started raising rates. When he raised rates, he was raising it 2.5% every meeting until he got to 18%. But he started at 7%. Think about that. I mean, right now we're starting at 0. And we go up 0.25%. The Fed was already at 7 when inflation started hitting. And they raised aggressively until they got to 18%. And those old enough to remember, if you bought your first house back in those days, you had 10, 12, 13% mortgages. And I don't think we're going to see that again. So the markets are betting that the Fed's making a policy error, that they're going to raise rates, the economy is going to go into recession, and inflation is going to continue to run. And that's stagflation, a stagnant economy with rising prices. Why is that so bad? Well, when you have a stagnant or recessionary economy, people lose their jobs. There's less income. How would you like to make less income or be out of work and have rising prices at the same time? Worst economic scenario you can get. But I tell you, I don't think I've ever seen the stock market being so volatile, so risky, that it is a casino right now. People are just making bets. There's no investing going on anymore. Oh, sure, there's some long-term investors that don't do anything regardless of what the market's doing. But everything's a bet. What happens if you wake up tomorrow morning and let's say Ukrainian President Zelensky is killed? Or even worse, some kind of nuclear weapon is used by Russia. And we'll talk later in the program how I never thought Russia would be as brutal to civilians, the civilian population of Ukraine. I mean, it's just Hitler-like. We'll discuss that in the second hour. But boy, the market is so headline-oriented right now. I mean, you can get killed with one headline. You know, you could be down 10%. And so people are just betting. What you see in the market now is just short-term trading, high-frequency trading. People just, taking a shot that, the market's low. It's gone a lot, it's going to bounce sooner or later. Let me try to trade that. But it's very, very easy to get hurt in this market. And I'm starting to see people are starting to get scared. And if we do move into a recessionary economy because of rising interest rates, we're starting to see housing sales starting to slow down. We've seen a major bubble in housing where 30 people are bidding for homes. People are selling homes above their asking price. That may be coming to an end. Mortgage rates went over 4% this week and will continue to rise if the Fed keeps raising interest rates. But just realize we're in for years of turmoil. Even if there is some kind of a ceasefire with Ukraine and Russia, the world is at war with Russia and will continue to be. Russia just can't do this. They just can't do this and say, okay, we're going to take all our equipment home and we're going to stop the war. Well, they're not only going to stop if they get certain concessions, a puppet government, whatever. Not joining NATO, what have you. But then they're going to worry about, okay, Ukraine's not going to join NATO, but what about Poland, who already has? What about Lithuania and Latvia and the Baltic states that are right on our doorstep? And while I'm not a pro-Russian, pro-Putin guy, I understand his concerns. And I laid it out in the last few weeks. I mean, would you want Russia to have missiles and their army in Canada and Mexico? I mean, we almost went to nuclear war in 1962 because of Cuba. And the Russians wanted to put nuclear missiles there. Well, it's the same thing for Russia right now. This is their missile crisis. They're worried about, NATO moving right up to their border, which we already have in the Baltic states. And that's supposedly the reason he went into Ukraine. But even if he says, you know what? And by the way, the war is not going well for Russia. We'll talk about that later. But, if he finds a face-saving way to get out of there, what do you think? It's over? It's not. We are in a time now of warfare. We're in nuclear financial warfare with Russia right now. And in my whole life, I was 2 during the Cuban Missile Crisis. I didn't know nothing about nuclear war. But my father would tell me he was afraid to go to sleep at night, not knowing if we were going to wake up the next morning. And now to hear talk, about potential nuclear weapons being used, it's scary stuff. Back to the financial markets. Again, stock market, very, very risky right now. Many people have way too much in the stock market. That's because the market has risen so much over the last few years. If you were an investor that wanted 40% of your money in stocks, 60% in bonds, now you're out of whack. You may be 60% stocks. So you got to reevaluate your asset allocation. Maybe you have too much in the market. I had some new clients, a couple of them that came in this past week, very concerned about their portfolios because they have too much stock market exposure. And they say, oh, last month I lost, $20,000. Everything I made last year is gone. And volatility makes people crazy. Now, another thing happened this week, very, very significant. Most people don't understand it, and that's the inversion of the yield curve. What is the yield curve? The yield curve is interest rates at different maturities in the Treasury bond market. The theory always is that the shorter the maturity, the lower the interest rate. The longer the maturity, the higher the interest rate. The longer you're going to lock up your money, the more compensation you should get for it. So typically the 30-year Treasury bond would yield a lot more than a 1-year Treasury bill. A 30-year would yield more than a 10-year. A 10-year would yield more than a 5-year. Inversion occurs when the short-term rates are higher than the long-term rates. And that's exactly what happened this week between the 5-year Treasury and the 10-year Treasury. The 5-year Treasury yielded more than the 10-year Treasury. That's an inversion. And the real inversion happens when a 2-year is higher than a 10-year. And that's only 1/3% away. That'll probably happen in the next week or two. Now, it's not true that every hiking cycle by the Fed, when the Fed starts raising rates, not every time does that lead to a recession. But all hiking cycles that invert the curve have led to recessions, usually in 1 to 3 years. Short-term rates, higher than long-term rates, cause recessions. And that happened this week. And I think the Fed wants to push the U.S. economy into like a modest recession. I guess they figure if they push us into a modest recession, it'll lower inflation. I don't think that's going to happen because I think inflation, there's a lot of things that are going on there besides just monetary policy, which monetary policy is obviously the big driver of it, but supply chain issues is one, value of the dollar is another. No U.S. recession in the past 70 years have occurred until the 2-year has inverted versus the 10-year, where 2-year paper is yielding more than 10. And on average, it takes 12 to 18 months from inversion to recession. But then again, the Federal Reserve has never in history started hiking rates when inflation was already 7.9% and 10% on wholesale prices. So we have a high risk that in 2023 we will be in a recession. The question is, will we still be in recession with inflation? And I think that's the way it's going to be. Gasoline prices, thankfully, oil prices have retreated a little bit in the last week. It was as high as $130 a barrel 2 weeks ago. It went as low as, I think, 97 this week. I think it closed a little over $100 a barrel. So we're still talking really high energy prices, and it's going higher again. We saw a little bit of a decline in gasoline prices. I know my local Wawa, was at $4.29.9 last week. Coming in today, it was $4.09. The Parkway was $4.37. It was as high as $4.49 last week. So a little bit of a break, but not enough to make a big difference. And this high energy prices are really hurting people. But it depends where you live, what country you live in. What is it? What percent of your monthly income goes to filling up a tank of gas? I thought this was very interesting. I came across this in my show prep. In the United States here, to fill up a 16-gallon tank, it takes 1.22% of the average American's monthly salary. That's one of the better countries. Why? Because we're affluent in America. We have pretty good income. But the worst country is Greece. Greece, it takes 5.6% of your annual salary, of your monthly salary to fill up a 16-gallon gas tank. So if you're filling up once a week, 24% of your monthly income will go to gasoline. So where does that money come from? Does it come from food? I don't know. I thought that was a very interesting statistic. Depends where you live. Same is true of rising food prices. Depends where you live. You live in a developing economy or a third world economy like Africa, some of the countries there, a good portion of your money goes to eating. So when you have food inflation, it's very, very painful, to the point of causing hunger in some cases. And we'll talk about food inflation, after the break. Let's take a break. 732-237-9626 is our call number. We take any question, any comment on any money matter or anything else here on The Financial Physician. My name is Lou Scatigna. Don't go away.